Hey, by now everybody's saying, what's going on with the rates? Mortgage rates seem to be going up. I'm hearing mortgage rates are going up. You'd be hearing right. Only the fixed rates. So about the 5-year fixed, 3-year fixed, 4-year. So what's going on, Ron? Ron said that they're going down. That rates are going down. And now they're going back up again. Like, what's going on? Well, what Ron actually said is rates will eventually come down, and they will. And Ron said, take variable, because variable will come down. Variables come down already, 75 basis points. So it's going to keep coming down. So let me explain. As I've said, 180 times, the movement of fixed rates, a traded commodity, these are the trading of Canadian government bonds, produces different yields each day, each hour of the day, each minute of the day, produces different yields upon which banks and other lenders base their 5-year, 3-year, 4-year fixed rates. That's just how it works. So those numbers will bounce around. It's a traded commodity. It's what people who are the traders, not a huge number, it's a huge number of investors. It's a huge number of people who are buying the bonds, a huge number of entities, of financial companies, of pension funds, of insurance companies. There's tons and tons of different companies buying the bonds. But the people doing the actual trading is not necessarily a huge number. So it's what they're thinking that day. And there's a whole industry of people behind these thoughts of where these bond yields are going, where the price of bonds is going. It's a big industry of smart people who make the decision at the end of the day for their trading operations. And they see new things. Price of oil goes up. Looks like World War III in the Middle East. Hey, those yields got to change. Like, we got to sell, buy, whatever, okay? And then, look, oil's coming down again. Energy's dropping again. Doesn't look like the war is much down. I mean, it's still some issues, there's some danger, but not like it was when it was super hot. So, as I've said 300 times, not linear. There's going to be bumps. But what can we say for sure? We can say that the economies of many countries are suffering, Canada in particular. Now, while everybody says, but Ron, like Canada can't detach, Canada's got to follow the U.S., they got to follow the U.S. Fed. Yeah, they do, but the U.S. Fed dropped 50 basis points, probably to be helpful to China. We're trying to figure out right now, and they've had some good jobs numbers and some other things have happened, but at the end of the day, the Canadian dollar, what everybody said, well, if we get too far detached, I mean, the dollar's going to go to hell. Canadian dollar is actually slightly up from 3 months ago. Just want to let everybody know. Hey, the destiny of central banks around the world is to reduce rates. Might be slower in the U.S. because their economy runs hot. They run deficits. They spend money. Government spends money in the United States that would make our federal government just look like nothing, like insects. Money is flowing, creates jobs, creates a buoyant economy. Huge deficit, mind-bending. But bottom line is this. Our central bank, the Bank of Canada, will reduce rates. It will continue to reduce rates. Eventually, the Fed will reduce rates. The other central banks around the world will reduce rates. And that means that variable rates come down. Look, let's assume that Bank of Canada gets to 3%. Let's even say, let's go nuts and say gets down to 2.5. That's a variable rate somewhere between 3.5 and 3.75. That's the rate you can get on your mortgage. That's the interest rate you pay on your mortgage once our Bank of Canada goes all the way to their final resting point, the terminal rate. Now, what does that mean? That means a 5-year fixed should probably be somewhere between 3.69 and 3.89, because the reality is that 5-year fixed should always be more expensive than the best available variable rate. That's just the way it works. It's as eternal how this works. Now, Pretty soon, the 3-year, the 5-year, 5 years probably going to go to 4.19, 4.24. 3 years going to jump back up to 4.39. It was as low as 3.99, jumped up. But here's what we need to understand. If your renewal's coming or you're purchasing a home and you take variable, it will come down. The central banks will reduce their rates. Eventually, it could be the middle of next year. Eventually, we will see fixed rates, 5-year, 3-year, 4-year, in the threes, high threes. Never said anything else. But listen, this is important. Anybody who's dreaming of 2.89 again, anybody who's dreaming of 2.49 again, it is a dream. It is not reality. There's nothing that would tell me that rates will be in the twos at any point next year, the year after. I think we just take that whole idea off the board for the time being. What's the focus? The focus hasn't changed. Take variable, watch it drop, keep an eye on the fixed rates, the 5-year fixed. Eventually, there will be an opportunity. This is not a linear progression. There will be ups and downs, but eventually, because of the terrible economy that Canada is going to be entering, the somewhat lousier economy that's going to be experienced in the U.S., we will see lower rates from our central banks. That's just the way it's going to go.